Hey guys, Will Lopez, founder of advisorfi.com. We're actually going to cover a really important topic today. While it's a topic that I'm actually not asked directly about, it's actually one that I have to back up to every single time when I'm trying to explain why an S Corp structure is advantageous. So what we're going to do today is we're actually going to talk corporate structure, and we're actually most importantly of the corporate structure, that is of an LLC or an Inc., which is a corporate structure, how that corporate structure has different tax classifications. So we're actually going to do a tax classification 101 class. So before we begin, if you'd like to schedule free time with us, feel free to click on the link below or go to meetme.so/freebie to schedule a 30-minute consultation with us. So what we're going to do today is go over tax classifications of an LLC and tax classifications of an Inc. That is, are there differences of the way the money that you make through an LLC? Are there differences in the way it's taxed, the way the IRS looks at that money? Well, yes, there is, and I'll explain that. And why the S Corp structure may be the way to go for a majority of LLCs and Incs, and especially for most importantly for you. So what we're going to do is go over the LLCs and the Incs together. So where people actually don't understand, they actually don't understand this as far as that LLCs and Incs have actually different tax classifications. They think that an LLC and Inc. is treated all the same. So what I want to try to do is kind of back up and explain that. When you make money, the IRS actually looks at that dollar that you earn differently. That is, they actually look at the dollar that you make through your business or just outside of a business or through your W-2 all differently. And people don't realize that the IRS does that. So when you make a dollar, you may think, well, I just made a dollar. Well, the IRS will ask the question, well, what kind of dollar did you make? Did you make a W-2 dollar? Did you make a dollar from interest from your bank account? Did you make a dollar from selling stock? Did you make a dollar from your Schedule C? Did you make a dollar from your partnership? Did you make a dollar from an S Corp structure? So if you can understand the concept that the IRS looks at a dollar differently and that the potential of saving money is to make your dollar come down to you in a way that can mitigate your taxes, then you will understand why the S Corp structure is advantageous. So the way I liken corporate structuring and tax classifications of LLCs and Incs. is like this. Think of an LLC or an Inc. as a BMW. One's red and one's blue. Can your BMW have different kinds of interiors? Well, of course it can. It can have a leather interior. It can have a cloth interior. Does that make your BMW different? Well, no, it doesn't. It's still a BMW, but you can actually have different kinds of interiors inside your BMW. So think of an LLC and an Inc. the same way. The LLC is the red BMW. You can actually have 5 different interiors inside your red BMW. The Inc. is a blue BMW. You can actually have 2 different kind of interiors inside the Inc. So what I'm going to do today is explain that your LLC and your Inc. actually has different kinds of interiors. And when you make money inside your vehicle, depending on the way the interior is, the way the money comes down to you, it's taxed differently. So let's go over the LLC tax classification of the LLC vehicle, and you'll understand quickly why the S Corp structure is advantageous. So LLCs have 5 different tax classifications. The first tax classification is a sole proprietorship. Many of you have heard of this term. It's very popular when you go out and you start making money on your own. It's the default structure, whether or not you actually have an LLC. So an LLC, when owned by one person, defaults into what they call a sole proprietorship. All the incomes and expenses you file on your Schedule C, on your personal tax return, the income and the losses that you make through the LLC taxed as a sole proprietorship passes through down to you. That's why you put it on your own personal tax return. And any income that you make through the sole proprietorship pays self-employment tax, which is Social Security and Medicare tax. The second kind of interior your LLC can have is a partnership interior, that is a partnership tax classifications. Now, this is when 2 or more individuals or other businesses own an LLC. This too, once again, is the default interior to a partnership when 2 or more businesses or individuals own an LLC. Any incomes or losses through that tax classification passes through the entity and goes down into the owner's respective personal tax returns. Any incomes generated inside the partnership vehicle and where the interior is partnership pays self-employment tax, which is Social Security and Medicare. The third interior that your LLC can actually have is what they call a C Corp structure. Now, this is really popular for companies who want to go public, companies who want to have, different kinds of stock like common stock or preferred stock, or they want more than 100 shareholders. If you want details on all the complexities behind the C Corp status, there's some links below that actually refer you to IRS guidance where you can do a little more reading. But it files its own tax return. It files actually Form 1120. In order to elect C Corp tax classification through the LLC structure, you have to actually fill out Form 8832. The income and losses do not pass through. That is, any income that the C Corp makes actually pays corporate tax, and then any dividends sent out to shareholders also pays tax again. That's why it's also known as the double tax corp, because any income at the corporate level pays corporate tax, and then dividends sent out to the shareholders, well, they also pay tax on that same dollar, double tax corp. The fourth interior that an LLC can have, which is why you're watching this video, is the S Corp structure. Now, the S Corp structure is not the default interior to an LLC, regardless of one or more than one people own it. It's actually an interior that has to be elected. So it's basically like getting the red BMW and just getting the default cloth interior. The manufacturer is not going to give you the nicest interior. They're actually going to give you the worst interior. They're going to give you that cloth interior, maybe the beige one that stains up really good. So the IRS, in like manner, will not give you the best interior. They're going to give you the default interiors. And the default interiors are sole proprietorships and partnerships. That's the default. If you want C Corp or S Corp, you're going to have to elect for those interiors. So when you elect for the S Corp in tax classification interior, you actually fill out Form 2553. The S Corp structure does file its own tax return, Form 1120S. Any incomes or losses made through that vehicle with the S Corp tax classification interior passes through that vehicle down to the owners, and then the owners claim the income or claim the losses, and then the owner basically pays taxes accordingly. Most importantly, the incomes and the losses that come down, or mostly the income, does not pay self-employment tax. That is, it does not pay Social Security and Medicare tax. Now, you may think to yourself, whoa, how's this possible? All the other ones pay self-employment tax. Well, once again, the IRS looks at dollars differently. They're basically asking this question. Even though you've made the same dollar, why is this dollar through an S Corp structure not pay self-employment tax? Well, I'm going to explain that concept. And the fifth tax classification for LLCs is basically disregarded entity. So this is basically when an LLC is wholly owned by another business. It just goes, it gets claimed on the other business's tax return. Inc. tax classifications. So once again, we've covered LLCs. Now we're going to cover Incs. Now, Inc. is the blue BMW. Blue BMW has different interiors. In this case, it actually only has two interiors. The first interior is the C Corp structure, which we just discussed. You file Form 1120 corporate tax return. In order to get this structure, you fill out Form 8832. Now, this actually inside of Inc. is the default interior inside of Inc. And obviously, if you're noticing a trend here, the default interiors are the most aggressive when it comes to taxes, because the default interior of your Inc. here is the double tax corp status, C Corp status. If you want a different interior of your Inc., you actually have to elect for it. And the only other interior that you can get inside your Inc. is the S Corp interior, that tax classification. You fill out Form 2553. It follows its own tax return, Form 1120S. Incomes and losses, like before, pass through it. And once again, does not pay self-employment taxes. So let's talk about why the S Corp saves money and why the profits of an S Corp versus a partnership versus a sole proprietorship versus a C Corp save you money in taxes. Well, let me explain a little concept that the IRS actually came up with. The IRS, when it looks at money and that dollar, when you pay taxes on that dollar, you actually pay the full realm of taxes. And what do I mean by the full realm of taxes? Well, every single United States citizen actually pays 3 federal taxes: federal income tax, federal Social Security tax, federal Medicare tax. Um, the next question you should ask yourself is, well, what kind of income pays those 3 taxes? Well, the IRS has actually come up with a term for that. They actually call it compensation. That is, if you make income and that income is called compensation, then you have to pay all 3 taxes: federal income tax, federal Social Security tax, and federal Medicare tax. Then what we're going to discuss today is, well, what is compensation? And can we receive that income not as labeled not as compensation, so we don't have to pay the full realm of taxes? Well, the IRS defines compensation as what they call salaries and wages. That is Form W-2. So if you actually look at your paycheck stub, you'll actually see the 3 taxes being taken out: federal income tax, federal Social Security tax, federal Medicare tax. That's why it's called compensation. The second form of compensation that the IRS labels as compensation is actually what they call earned income. Okay, and this is where we're getting a little deep here, but I'm trying to lay a solid foundation so you can actually understand why the S Corp saves money. Now, what is earned income? Well, earned income generally is this. That is, if you earn money and you, as a sole proprietor, that is a non-LLC, you go out and you sell stuff on Etsy, you go out and you sell stuff on Amazon, and you're claiming that income. That income is considered compensation, and it's called earned income. The other way the other kind of form of income is through an LLC that's taxed as a partnership. That is, when 2 or more people own a partnership, any income through that partnership passes through down to you, and that income is called earned income. The third kind of earned income that you can claim is actually an LLC where only one person owns the LLC, and once again, it's a sole proprietorship. So when you generate money through the LLC and you're a sole proprietorship, only one person owns the LLC, that profit comes down to you, and it's called earned income, and you pay federal income tax, federal Social Security tax, and federal Medicare tax. Compensation pays self-employment tax, Social Security, and Medicare tax. Now, Social Security tax is 12.4% of every dollar up to $118,000. So if your little Etsy account makes $50,000 as an LLC, as a sole proprietorship, and that's after all expenses, where you're going to pay self-employment tax, SE tax, and Social Security on that $50,000 is going to be 12.4% up to a cap, and Medicare is going to be 2.9%. So basically a total of 15.3% on every dollar of your self-employment income that is a non-LLC sole proprietorship, a LLC taxed as a partnership, or an LLC taxed as a sole proprietorship. So every dollar up to about $118,000 pays self-employment tax. Now, what is the S Corp profits? So if you earn $50,000 through your Etsy account through an S Corp, and not through an LLC taxed as a partnership, not an LLC taxed as a sole proprietorship, but an LLC taxed as an S Corp, what is the label of those profits? It's not compensation. So if you can understand this concept, that is, the profits of an S Corp is not compensation, then immediately it should trigger in your head, whoa, if it's not compensation, then it's not going to pay Social Security and Medicare tax. Now, what is it? It's ordinary income, and you only pay federal income tax, but it's not compensation. So this is where you actually find some tax savings, is because profits from an S Corp does not pay the full realm of taxes. It does not pay Social Security, Medicare, only federal income tax and state income tax if you live in a state that charges that. So what does this basically mean? Basically means that we're about to explain how you're going to win. So what I would like to do actually is show you a really cool calculator that I found, a nice, awesome website called Llc.com that kind of help explain this concept a little further and just kind of drive the point home. So as you're watching here, I'll show you a quick little website, really, really neat website called Llc.com. Before I go further, if you'd like to schedule some free time with us, feel free to click on the link below. or go to a web browser and type in meetme.so/freebie to schedule a 30-minute consultation. So this is an awesome website that I found a while ago. Really simple to explain the S Corp structure and why there's savings inside the S Corp structure. So if you go to myllc.com/corporate-calculator.aspx, you'll actually be able to play around with this. So what this is going to do is it's actually going to explain that the S Corp money that you make, the profits, is not considered compensation, therefore does not pay Social Security, Medicare tax. And then yet the entity that is a sole proprietorship or a partnership that gets subjected to self-employment tax, why it does pay that self-employment tax is because those profits are actually labeled as compensation, whereas the same profits through an S Corp structure is not labeled compensation. And the difference between the two will be your savings. So let's assume you have a business and let's say you're a freelance photographer and you make $100,000 after all expenses. So what we're going to do is we're actually going to put in $100,000 here. So it says enter the estimated yearly net income for the business. So we're going to say $100,000. Now, one of the rules of the S Corp structure, and I have actually another video that kind of dives into this, but one of the caveats of the S Corp structure is that you must run for yourself a reasonable compensation. I'm not going to dive into that. There's some links below that you can click on to help explain what reasonable compensation is. But basically, the reason why the profits of an S Corp does not pay Social Security, Medicare tax is because the assumption from the IRS is because you're not paying that through the profits of the business, we expect and we assume that you must pay yourself a salary. Now, what did I just explain salary is? Compensation. And what does that W-2 compensation pay? The full realm of taxes. So this is their way of kind of offsetting that when your S Corp doesn't pay Social Security, Medicare tax, they force upon you that you must pay yourself a wage, and through that wage, you pay Social Security, Medicare tax. So what we're going to do is just enter a salary. Now, this is where a variety of accountants differ in opinion regarding how much to pay yourself. In my eyes, if you were making $100,000 net, just roughly, I would probably say maybe 20 to 40% of profits. So I would say maybe $30,000 a year in your first year. So I would say, hey, we think your business is going to net $100,000 before W-2 wages. And then of the $100,000, we're going to pay ourselves $30,000 in wages. And so what this calculator is going to easily display is that self-employment tax that you would pay as a sole proprietorship with a salary of, it's actually going to put in the $100,000 because remember, when you're not an S Corp, the profits of the business is considered compensation, earned income. You pay the full realm of taxes, Social Security, Medicare, federal income tax, Social Security, Medicare. In this case, it's just going to show you self-employment tax, Social Security, and Medicare because that's the tax that we can actually manage a little bit. Federal income tax, everyone will have to pay, and no one can really avoid. But as an S Corp, we're actually going to pay the same Social Security, Medicare only on the salary. That is the salary that we set, not on the 100, but on the 30, because the difference between the two is not considered compensation. It's actually considered not compensation or just ordinary income and only pays federal income tax. So then now in your head you would think, wait a minute, I'm going to pay only Social Security, Medicare tax on 30 grand, and on the difference between 100,000 and 30,000, which is 70,000, I'm not going to pay Social Security, Medicare. And what you'll immediately see is a triggering in savings of Social Security, Medicare taxes. So if you were an LLC taxed as a sole proprietorship, all $100,000 would be subject to self-employment tax. If you were an LLC taxed as a partnership, all $100,000 would be subject to self-employment tax, regardless of what wages you take out. But if you were an S Corp and that same $100,000 were coming through, but of the 100, we would run $30,000 in wages in order to satisfy the IRS rule. Only the $30,000 would pay self-employment tax, Social Security and Medicare, but the rest of it would pass through down to you as ordinary income, and you would actually not pay Social Security and Medicare tax. Therefore, you would actually end up saving money from Social Security and Medicare tax because that $70,000 is not considered compensation. Now, some people have asked, well, this is tax evasion. Well, no, it's not. We're still claiming $100,000, right? We're still claiming that $1 of profit or income that we're saying we're making. See, in case one, we claim $100,000 of profits through our Schedule C or through a 1065. That is through a sole proprietorship or a partnership. We're still claiming the $100,000. But look at the other direction. The S Corp still claims $100,000. How are we evading income? We're not evading income. We're actually breaking apart that dollar, and we're saying 30 cents of that $1 is compensation. 70 cents of that same dollar is not compensation. I'm going to pay my fair share of taxes on the 30 and my fair share of taxes on the 70. But what you don't understand, what people don't realize is that of that 70, you actually don't pay all the taxes that 30 does pay. So on your own personal tax return, if you were to actually see how this actually flows down, we'll jump into a Form 1040 here. If you were a sole proprietorship as a Schedule C, you would basically see this 100,000 show up on line 12. That is Schedule C income. So all we're doing is we're basically saying, well, that dollar that we're claiming, we're going to break it apart, move it a couple different lines inside the personal tax return. Part of that dollar is going to be subjected to the full realm of taxes. That's the other part of that same dollar is actually not, but we're still going to pay federal income tax and state income tax based on whatever state we live in. So what we're basically doing in essence is we're actually saying, well, we actually don't want this $100,000 coming through into the Schedule C. We're actually going to break it apart. We're going to say $30,000 is actually coming in as a Form W-2 wage compensation, and then the other $70,000 is going to go up in line 17 as an S Corp, and we're going to say, well, we're going to claim it right here as $70,000, and then here it is. We're not misleading when we're claiming income. We're still claiming $100,000, except the difference is we broke apart the dollar, and of the $70,000 of that dollar, we're going to save a substantial amount of taxes. And that's basically how you save money as an S Corp, by basically understanding that a corporate structure like an LLC or an Inc. has different tax classifications or different interiors. And all we need to do is make sure that the dollar that we make inside that tax classification comes down to us as taxpayers in a way that is tax advantageous and helps minimize your taxes. So if you guys have any questions, feel free to schedule below. We give away 30-minute consultations, so feel free to go to a web browser, type in meetme.so/freebie for your free consultation. Take care, guys.